The financial media wants you focused on the Federal Reserve, on interest rate cuts, on inflation data. But while you were watching those headlines, something happened in Delhi that changes everything. January 14th, 2026. The Reserve Bank of India made a decision so quiet. The mainstream press called it routine portfolio adjustment. But here's what they're not telling you. This wasn't routine. This was a calculated demolition of the dollar system. And the mathematics behind it prove there's no way back. What India just did makes the 2008 financial crisis look like a practice round. If you're holding dollar-denominated assets right now, the clock just started ticking. Welcome to Currency Spot. Now, I need to ask you something important. If you've spent decades building your wealth, protecting your family's financial future, making careful decisions about where your money goes, then what I'm about to show you in the next 12 minutes deserves your full attention. This isn't entertainment. This is intelligence. Strategic economic intelligence that the mainstream financial press won't give you, because they don't understand the mathematics I'm about to walk you through. So here's what I'd like you to do. If you value clarity over noise, if you'd rather hear the analysis they won't publish on CNBC, click that subscribe button right now. Because this channel exists for one reason: to give serious business professionals like you the technical breakdown before the market catches up. And before we dive into the numbers from Delhi, drop a comment below and tell me, what city are you watching from today? I want to know where our global community of strategic thinkers is tuning in from. New York, London, Dubai, Singapore, Toronto? Let me know in the comments. Because what's happening right now, it affects every financial center on Earth. Now, let's talk about what the Reserve Bank of India just did and why the Treasury Department is pretending it doesn't matter. The global financial media spent the first 2 weeks of January 2026 focused on exactly 3 narratives. First, the Federal Reserve's potential rate cut in March. Second, the cryptocurrency regulatory framework coming out of Washington. Third, escalating tensions in the Middle East and their impact on oil prices. Every financial analyst, every market commentator, every investment bank research department was publishing reports on these 3 topics. The algorithms were optimized for these keywords. The headlines were written around these themes. And while the entire financial world was staring at these stories, something happened in Delhi that received exactly 47 seconds of coverage on mainstream financial networks, 47 seconds, for an event that fundamentally restructures the global reserve currency system. On January 14th, 2026, the Reserve Bank of India published its quarterly reserve management report. Page 63 of that report contained a single paragraph, 142 words. Those 142 words confirmed that India had reduced its holdings of United States Treasury securities by $58 billion over the previous 6 months. Bloomberg ran a 2-paragraph story. Reuters called it routine diversification. The Financial Times published a brief noting emerging market central bank rebalancing. And then, silence. The story disappeared from the news cycle within 18 hours. But here's what those financial journalists missed. Here's the detail that didn't make it into their analysis. Here's the mathematical reality that changes everything about global capital flows for the next decade. India didn't sell those treasury bonds because they needed cash. India's foreign exchange reserves stand at $640 billion, the 4th largest in the world. They didn't sell because U.S. yields were unattractive. During the same 6-month period, the 10-year U.S. Treasury was yielding between 4.2% and 4.7%, historically strong returns for sovereign debt. They didn't sell because of better opportunities elsewhere. The replacement assets they purchased, Chinese yuan-denominated bonds, were yielding 2.8% to 3.1%, significantly lower returns. So why did they sell? The answer is hiding in plain sight in the technical language of that reserve management report. Buried in the footnotes of page 63, there's a phrase that central bankers use when they're being diplomatic about a crisis. The phrase is strategic de-risking of counterparty exposure. In plain English, that phrase means one thing. India no longer believes that United States government debt is a risk-free asset. Let that sink in for a moment. The world's 5th largest economy, a nation of 1.4 billion people, a nuclear power, a permanent member of the G20, just officially reclassified American debt from risk-free to risk-requiring management. This isn't a small policy adjustment. This is a seismic shift in how the global financial system operates. For 75 years, since the Bretton Woods Agreement in 1944, the entire architecture of international finance has rested on one assumption. That assumption? United States Treasury bonds are the safest asset on Earth. Safer than gold, safer than any other currency, safer than any corporate bond, any municipal bond, any sovereign debt from any other nation. This assumption is what allows the U.S. government to borrow $34 trillion. This assumption is what allows the Federal Reserve to run a balance sheet of $7 trillion. This assumption is what makes the dollar the world's reserve currency. And on January 14th, 2026, India became the first major economy to publicly reject that assumption. Not with a press conference, not with a dramatic announcement, but with a quiet technical adjustment buried in a quarterly report that most people will never read. Now, here's where this gets critical for anyone holding dollar-denominated assets. India isn't acting alone. Over the same 6-month period, China reduced its US Treasury holdings by $42 billion. Saudi Arabia reduced holdings by $18 billion. Brazil reduced holdings by $12 billion. The United Arab Emirates reduced holdings by $9 billion. Add those numbers together. That's $139 billion of US debt sold by 5 countries in 6 months, and the mainstream financial press called it routine. But here's the mathematical problem that nobody is discussing. The United States Treasury needs to sell approximately $2 trillion of new debt in 2026 just to fund current operations. That's before accounting for the $9 trillion of existing debt that needs to be refinanced over the next 18 months. So the Treasury needs to find buyers for roughly $11 trillion of bonds by mid-2027. And the largest buyers in the world, the central banks of emerging economies, just started selling, not buying, selling. This is the story that the media isn't telling you. This is the mathematical crisis that's building beneath the surface of those Federal Reserve rate cut discussions. And this is why that phrase, strategic de-risking of counterparty exposure, should terrify anyone who understands what it actually means. Because when a central bank stops trusting your debt, the game has fundamentally changed. There's a reason why most people don't understand what just happened in Delhi. It's because the bond market operates on a principle that seems completely backwards to normal human logic. In the regular economy, when something becomes riskier, people demand higher compensation for that risk. If a bank thinks you might not pay back a loan, they charge you a higher interest rate. If an insurance company thinks your house might burn down, they charge you a higher premium. Risk equals higher cost. This is basic economics. This is how every market in the world works, except, apparently, the United States Treasury bond market in 2026. Let me show you the anomaly that's hiding in plain sight. October 2024, the 10-year US Treasury yield was trading at 4.08%. March 2025, that same bond was yielding 4.73%. October 2025, the yield hit 4.52%. January 2026, it's sitting at 4.61%. Now, if you don't follow bond markets, those numbers might not mean anything to you. So let me translate what that means in simple terms. When a bond yield goes up, it means the government is offering more interest to convince people to lend them money. A bond yielding 4.61% is paying significantly more interest than a bond yielding 2% or 3%. In theory, higher yields should attract more buyers, basic supply and demand. If a store starts offering a 50% discount, more customers should walk through the door. If a bank starts offering 5% interest instead of 2%, more depositors should open accounts. This is fundamental market behavior that has worked for centuries. But here's the anomaly that should make every financial analyst in the world stop and recalculate their assumptions. Despite yields rising to levels not seen since 2007, despite the US government offering the highest returns in 17 years, despite what should be an irresistible opportunity for yield-hungry investors, India walked away from the table, China walked away from the table, Saudi Arabia walked away from the table, Brazil, UAE, multiple emerging market central banks, all walking away from the table, not because yields were too low, but because something more important than yield changed, and that something is called credit risk perception. Here's how this works in the real world. Imagine you have a neighbor who wants to borrow money. 5 years ago, this neighbor had a stable job, a manageable mortgage, reasonable spending habits. You lent them money at 3% interest, and they always paid you back on time. Now, fast forward to today. The same neighbor comes back asking to borrow more money, but now their debt has tripled, their income hasn't increased, they're taking out new credit cards to pay off old credit cards, and they're spending more on interest payments than they're earning from their job, so they offer you 5% interest instead of 3%. Do you lend them the money? If you're smart, you don't, because the extra 2% interest doesn't compensate for the new reality that they might not be able to pay you back at all. The math changed, not just the interest rate, but the fundamental probability of repayment. This is exactly what India just calculated about United States Treasury bonds. The numbers tell the story. In 2008, U.S. federal debt was $9.2 trillion. U.S. GDP was $14.7 trillion. The debt-to-GDP ratio was 62%. In 2026, U.S. federal debt is $34.8 trillion. U.S. GDP is $28.1 trillion. The debt to GDP ratio is 124%. The debt doubled as a percentage of the economy. But here's the part that makes this a crisis instead of just a problem. In 2008, the annual interest payment on that debt was $253 billion. In 2026, the annual interest payment on the debt is $1.2 trillion. Let me put that in perspective. The United States government now spends more money on interest payments, just interest, not paying down the actual debt, than it spends on the entire defense budget, more than Medicare, more than all federal education spending combined. And here's the mathematical trap that India recognized before anyone else. When interest payments become the largest line item in the federal budget, there are only three ways out. Option 1, raise taxes dramatically to cover the interest payments. Option 2, cut spending dramatically on everything else. Option 3, print more money and inflate away the debt. India looked at the American political system and calculated the probability of option 1 or option 2 actually happening. That probability is effectively zero. No politician gets reelected by raising taxes 40% or cutting Social Security and Medicare, which means option 3 is the only realistic path. And option 3, printing money to pay debts, is exactly how you destroy the value of a currency. This is why India sold $58 billion of US Treasuries despite yields being at 17-year highs. They weren't chasing yield, they were avoiding a mathematical certainty. The certainty that when a government cannot tax or cut its way out of a debt spiral, it will eventually print its way out. And when that happens, the bonds become worth less, and the currency becomes worth less, and the purchasing power evaporates. India didn't want to be holding those bonds when the rest of the world figures out what they already calculated. Because once the broader market realizes this mathematical reality, the selling won't be $58 billion over 6 months. It will be $500 billion in 6 weeks. And when that happens, yields won't rise gradually from 4.6% to 5% or 6%. They'll spike to 8%, 10%, 12%, as the Treasury desperately tries to find any buyers at any price. This is the anomaly. High yields that can't attract buyers, because the buyers have done the math, and the math says the risk is greater than any interest rate can compensate for. There's a moment in every financial crisis when the technical problem becomes a psychological problem, when the spreadsheets stop mattering and fear takes over. 1929, it was the margin calls on stock speculation. 28, it was the realization that mortgage-backed securities were filled with loans that would never be repaid. 2026, it might be the moment when the global bond market asks a question it hasn't seriously asked in 80 years. What if the United States government can't actually afford to pay back its debt? Not won't pay back, but physically, mathematically, cannot pay back. And India's quiet exit from the Treasury market is the first crack in the dam. Here's why the crack matters more than most people realize. The US Treasury bond isn't just an investment instrument. It's the foundation of the entire global financial system. It's the collateral that banks use to borrow money overnight in the repo market. It's the asset that pension funds hold to match their long-term liabilities. It's the reserve that central banks around the world store to back their own currencies. It's the benchmark against which every other bond, every mortgage rate, every corporate loan is priced. When you apply for a car loan, the bank looks at the Treasury yield and adds a percentage on top. When a corporation issues bonds, they price it as Treasury plus 2% or Treasury plus 3%. The entire architecture of credit markets is built on top of the assumption that Treasury bonds are stable, reliable, and safe. So what happens when that assumption breaks? Not slowly, but suddenly? Let me walk you through the 3 systemic vulnerabilities that India's move just exposed. Vulnerabilities that most financial analysts aren't even monitoring, because they're too dangerous to acknowledge publicly. Vulnerability number 1, the refinancing wall. Between now and December 2027, the United States Treasury has $9.4 trillion of existing debt that comes due. That debt needs to be refinanced, which means the Treasury needs to find buyers willing to purchase $9.4 trillion of new bonds just to replace the old bonds that are maturing. That's before they borrow a single dollar for new spending. Now, in a normal market, this wouldn't be a problem. The old bonds mature, the holders get paid back, and they immediately use that money to buy the new bonds. It's a smooth rollover. The money just cycles through the system. But what happens if the old bondholders decide they don't want to buy the new bonds? What if they take their money and buy something else instead? Gold, perhaps? Or yuan-denominated Chinese bonds? Or real estate in Dubai? Or silver? Suddenly, the Treasury has to find completely new buyers for $9.4 trillion. And here's the mathematical problem. The entire foreign official sector, all central banks combined, holds approximately $7.6 trillion of US Treasuries right now. If even 20% of them follow India's lead and reduce their holdings, that's $1.5 trillion of selling. Which means the Treasury needs to find $1.5 trillion of new buyers just to replace the foreign central banks who are leaving, plus the $9.4 trillion for refinancing, plus the $2.1 trillion for new deficit spending in 2026. That's $13 trillion of bonds that need buyers in the next 18 months. There aren't that many buyers on planet Earth. Vulnerability number 2, the currency swap dependency. Most people don't know this, but the dollar's dominance isn't just about people wanting dollars. It's about people needing dollars. Here's how it works. Let's say you're a company in Thailand, and you need to buy machinery from Germany. You don't pay in Thai baht, you don't pay in euros, you pay in US dollars. Why? Because that's how the international banking system is wired. So the Thai company goes to their bank, and the bank provides dollars through something called a currency swap line with the Federal Reserve. It's a complex system, but the simple version is this. The Fed provides dollars to foreign central banks, and those central banks distribute dollars to their local economies. This system gives the dollar massive structural demand. Even if people don't want dollars as an investment, they need dollars for transactions. But here's what India just signaled. By reducing their treasury holdings and increasing their yuan-denominated bond holdings, they're building alternative currency swap arrangements with China, with Russia, with the BRICS payment system. They're creating a parallel financial infrastructure that doesn't require dollars for international trade. And if that infrastructure becomes operational, if companies can buy machinery and oil and wheat without needing dollars, the structural demand for dollars evaporates. And when demand evaporates, price collapses. Vulnerability number 3, the collateral crisis. Every night, approximately $4.5 trillion moves through the US repo market. This is the overnight lending market where banks and financial institutions borrow money for 24 hours. And the collateral they use for those loans? US Treasury bonds. A bank pledges $100 million of Treasury bonds, borrows $98 million in cash, and pays it back the next day. This happens thousands of times every single day. It's the plumbing of the financial system. But this system only works if everyone agrees that Treasury bonds are worth what they say they're worth. The moment people start questioning the value of that collateral, the moment someone says, I don't want to lend you $98 million against those bonds, I'll only lend you $85 million, the entire system seizes up. We saw a preview of this in September 2019. The repo market suddenly demanded 10% interest rates instead of 2% interest rates overnight. The Federal Reserve had to inject $278 billion in emergency funding to keep the system from collapsing. That was when Treasury bonds were considered completely safe. Now imagine what happens when India, China, Saudi Arabia, and other major holders are actively selling treasuries. Imagine what happens when the market starts pricing in real default risk. The repo market doesn't just demand higher rates, it stops accepting treasury bonds as collateral altogether. And when that happens, banks can't borrow overnight, payments don't clear, financial institutions can't meet their obligations. The system freezes, not over weeks, over hours. This is the cascade that India's quiet exit just set in motion. They didn't just sell bonds, they revealed that the foundation everyone thought was solid is actually fragile. And once that revelation spreads, and once other central banks start running the same calculations India already ran, the mathematics of confidence turn into the psychology of panic. And panic moves faster than any central bank can respond to. There's a graveyard of reserve currencies that most people have never heard about. Currencies that once dominated global trade. Currencies that everyone believed would last forever. Currencies that collapsed anyway. The Dutch guilder ruled international commerce for over a century. From the 1600s through the early 1700s, if you wanted to trade spices, textiles, precious metals, anything of value across borders, you did it in guilders. Amsterdam was the financial center of the world. Dutch banks were the most trusted institutions on the planet. And then, gradually, then suddenly, it was over. By 1780, the guilder was a regional currency. By 1800, it was irrelevant to global trade. What happened? Debt. The Dutch Republic borrowed heavily to fund wars with England and France. The debt-to-GDP ratio climbed above 120%. Interest payments consumed more than half of tax revenues. And foreign creditors, the same creditors who had funded Dutch dominance for generations, started asking a simple question. Can they actually pay this back? The answer was no, and once that answer became obvious, the guilder lost its reserve status in less than 2 decades. Then came the British pound. For 130 years, from 1815 to 1945, the pound sterling was the unquestioned king of global finance. The Bank of England was the central bank of the world. British government bonds were considered safer than gold. The sun never set on the British Empire, and the pound never lost its dominance. Until it did. World War II forced Britain to borrow massive amounts. By 1945, Britain's debt to GDP ratio hit 250%, the highest in the developed world. But here's the critical detail that most economic historians miss. Britain didn't lose reserve currency status because of the debt level. They lost it because of who they owed the debt to. During the war, Britain borrowed heavily from the United States, from Canada, from Australia, from Commonwealth nations and allied powers. And after the war, those creditors had a choice: keep lending to Britain at low rates and hope they eventually get paid back, or shift their reserves to a new creditor, one with a stronger economy, lower debt ratios, and most importantly, one that was a net lender instead of a net borrower. They chose the United States, and the Bretton Woods Agreement of 1944 officially transferred reserve currency status from the pound to the dollar. It took exactly one generation for the world's most dominant currency to become a secondary option. Now, here's the question that should make every serious investor stop and recalculate their assumptions. Why would 2026 be any different? The United States debt to GDP ratio is 124%, not as high as Britain in 1945, but climbing steadily. More importantly, the US is now a net borrower from geopolitical rivals. China holds over $700 billion in US debt. Japan holds over $1 trillion. These aren't allies helping a partner during a crisis. These are strategic competitors with their own interests. And when India, the world's most populous democracy, decides that US debt is no longer risk-free, that's the historical parallel to 1944. That's the moment when creditors start looking for alternatives. But there's one critical difference between 1945 and 2026. In 1945, the transition from pound to dollar was orderly. It was managed through international agreements. The British government cooperated with the transition because they had no choice, but at least there was a framework. In 2026, there is no framework. There is no Bretton Woods 2.0 agreement. There's no coordinated transition plan. There's only the free market, making individual decisions, creating a cascade that no single institution can control. This is what the phrase Great Reset actually means. Not a conspiracy, not a plan to take over, but a forced restructuring of the global monetary system because the current system's mathematics no longer work. And when that restructuring happens without coordination, history shows it doesn't happen smoothly. It happens chaotically. So, what does a rational business owner, a strategic investor, a careful steward of wealth do with this information? Here's the framework that serious decision makers are already implementing. Immediate actions. The next 90 days. First, assess dollar-denominated exposure. How much of your liquid wealth is in U.S. bank accounts, U.S. money market funds, U.S. Treasury bonds? If that number is above 60%, you have concentration risk. Concentration in the one asset class that India just signaled is no longer risk-free. Second, establish a precious metals position, not a speculation, as insurance. Gold and silver have functioned as monetary reserves for 5,000 years. Through every currency collapse, every sovereign default, every reserve currency transition, physical precious metals retained purchasing power. A 5% to 15% allocation is not radical, it's prudent. Third, diversify banking relationships. If all your capital is in U.S. financial institutions, you have jurisdiction risk. Open accounts in Singapore, Switzerland, UAE, jurisdictions with strong banking systems and lower sovereign debt ratios, not to evade taxes, to reduce single point of failure risk. Medium-term positioning, 6 to 18 months. Fourth, review supply chain dependencies. If your business relies on inputs priced in dollars, or vendors who only accept dollars, you have operational currency risk. Start building relationships with suppliers who can invoice in alternative currencies. Yuan, euros, even gold-backed settlement systems. Fifth, consider hard asset acquisition. Real estate in stable jurisdictions, productive farmland, energy infrastructure, warehouse facilities, assets that generate cash flow regardless of which currency is dominant. Sixth, build international revenue streams. If 100% of your revenue comes from U.S. customers paying in dollars, you have market concentration risk. Expand into BRICS economies. India's middle class is 350 million people and growing. China's consumer market is 1.4 billion people. These markets will grow regardless of dollar dynamics. Strategic adaptation, 18 to 36 months. Seventh, stress test your business model. What happens if interest rates go to 8%, 10%, 12%? Can your business service debt at those rates? Can your customers afford your products if their borrowing costs double? If the answer is no, restructure now while rates are still manageable. Eighth, preserve liquidity. In chaotic transitions, cash is king. Not because cash holds value forever, but because cash gives you optionality, the ability to buy assets when others are forced to sell, the ability to survive disruptions that bankrupt over-leveraged competitors, maintain 12 to 18 months of operating expenses and liquid reserves. Ninth, prepare exit strategies. Know what you would sell, to whom, and at what price if you needed to liquidate quickly. Have those relationships built now, not when you desperately need them. Here's the final truth that most financial advisors won't tell you, because saying it out loud costs them clients, but it's the truth nonetheless. The Great Reset isn't a future event that might happen. According to the mathematics visible in India's decision, according to the historical precedent of every reserve currency transition, according to the debt spiral that cannot be reversed through policy alone, it has already begun. The only variable now is timing, and the only question that matters is this. When the broader market realizes what India already calculated, when pension funds and sovereign wealth funds and institutional investors around the world start running the same numbers, when the cascade turns from a trickle into a flood, will your assets be positioned on the right side of the currency transition? Or will you be the case study that future economics students analyze? The example of what happens when you wait for CNBC to confirm the crisis instead of acting on the signal while there's still time to adapt? India sent the signal. The Reserve Bank of India doesn't make impulsive decisions. They calculated the risk, they ran the numbers, and they got out. The clock is ticking.